Hello and welcome to the Download. I'm your host, Dave Richardson, and I am so excited about this podcast today. My guest is my cherished colleague and mentor, Dan Chornous, the Chief Investment Officer at RBC Global Asset Management. Dan, it's so great to have you on. Thank you. Thanks for accepting the invitation. And how are you doing today?
Good, but after that introduction, I hope I don't let you down.
Oh, we know you're never going to let us down. We know that what we're going to talk about today is so critically important, and we'll get to that in a second. But the one thing I wanted to just check in on, because we've talked about it before quite a bit on the podcast over the years, is you've moved over to London, England now, and you've been there for a few months, and I know going back years and years, you've always thought London was such an important place for the firm to be in terms of positioning it as a true global investment manager. Now that you've been a few months there, and we've gone through Brexit and everything over the years, what are your thoughts about what's going on in London from an investment perspective, and are you enjoying it? Is there anything special you're doing there? Maybe just update us on what you're up to over there.
Well, on a personal level, Brendan and we've been there 6 months now, and we're having a terrific time. This is hoping that you've all been there, but if you hadn't had a chance, one way or another, find yourself to London at some point in your life. It's like New York City. Whatever you enjoy, it all happens there. It happens there bigger than anywhere else, and there's no end to it. So it's an endlessly fascinating city, and it's worked out so well for us corporately, or as the GAM and the business. That part's been thrilling as well. That's the size of the operation that we have on the ground in GAM. The trading wars, by several factors, I guess the largest we have within the business, larger than Toronto, larger than Vancouver, maybe larger than Vancouver and Toronto put together. Now, part of that is because of the way that we actually have people situated. We have them sitting in a traditional investment bank trading floor type of environment, because it fits really well with the fixed income dominated organization that we have over there. But nevertheless, the type of people, the amount of skill that exists on that one floor, to be a part of that every day. I mean, I've enjoyed that through my career. Now I'm enjoying it in London. Yeah. Other thing that we get from the London business is that while Toronto's a very important financial center, and it is a very important financial center, that in London there are so many things going on in global finance that we have windows on, or deeper windows on, or whatever the right word is for that. And I found through this transition, particularly in the United States and geopolitics, that you really do feel, closer to the news source, and that's been a great benefit to us, I think. So again, the quality of people we have within GAM, their global view. It's helped also that many of them have actually, long short views, alternative asset experience. That's been brought into the firm. I think it's a great thing for all of us.
Yeah, and the first thing I'll say is absolutely agree. Just from a personal perspective, for anyone listening, if you haven't been to London, it's a place you have to go. And it's funny though. I was just I'm in Nanaimo today, and I went to my little coffee shop here in Nanaimo. Fantastic, world class coffee place. But the two young people behind the counter have never been to Toronto, and they're talking about what a great experience it'd be to go to Toronto. And I was sharing that, having grown up in Toronto, and now you come on here and you're talking about living in London, and I just agreed. London is just fantastic. And then I know, because of you, I've had the chance to go to London many, many times from a work perspective, and that's where you see the importance and just as you say, the difference between even a big financial center. And from a Canadian perspective, Toronto is the center of the universe from a financial perspective. But then you go to London and you're just, oh, okay, this is at a different level. This is where you need to be. And you're still a Canadian, Dan. Like, I mean, this is the one thing that I always say to people. We're still a Canadian firm, so we bring a Canadian mentality. We're thinking about Canadian investors, but we've got to go out with our expertise, your expertise, and go to places like London so that we can bring the very best of everything around the world to a Canadian investor because it's so critical. Canada, as much as we love it, is still small from an investment perspective.
Although I think, and I agree with everything you said. In fact, Dave, I'll show you. I wore my Canadian cufflinks today for the the I do think that the firm has an awful lot to offer the world as far as investment process, results, breadth of investment product, talent, all these things. So, I do believe that I have the reason when you say the world needs more Canada. And I do think in the case of investment management, we got something to offer there too. That's been a really exciting thing to be a part of.
Yeah, and a great point to make. We've had Dan on before. You can go back if you subscribe to the podcast, which you can do anywhere, any of the platforms you have that offer a podcast where you download a podcast. You can go back in the archive. All the episodes are there. And Dan actually talks a lot about process the last time that we had him on, and about that, bringing Canada to the rest of the world. I think you'll really enjoy it. So subscribe and rate the podcast. We love that. We always say that, Dan. But let's go to the main reason I wanted to get you on today is the paper that you and the team have produced recently, and it's I guess it's a recast of an old paper, and I'm sure you'll get that from the 1990s that was worked on by someone else, but you brought it forward, and the insights are so critically important. I've been talking about a lot on the podcast and when I'm out with investors. Just the whole idea of what we've kind of seen coming out of COVID is that we've seen a lot of investors, so people who should be investing, becoming savers, right? So sitting in cash, interest rates moved up a little bit. Oh, I'll take the higher rate of interest and I'll just sit on the sidelines. Oh, I don't want to take any risk. And they think of risk only in the ups and downs of the stock market or bond market. And certainly there's been enough things to be concerned about, but you're not investing when you're saving. There's a distinct difference between the two. And then on the other hand, we see all kinds of people, given the markets that we're in right now, speculating or gambling, which is also not investing. And what I think this paper does such a great job of doing is highlighting. Now, that's primarily for retirees, and I'll let you explain the paper. But I think it highlights it for everyone, the importance of investing. Right? If I save, I'm losing ground likely to inflation. And you'll talk about that in terms of what that means in retirement. If I'm just sitting in cash or a cash equivalent. If I'm gambling, when I go to the casino, the odds are I'm going to lose. So I might win for a little while, but I'm ultimately going to lose. But when I invest, right, if I look back at history, I have generally over time, the longer I play, the longer I'm in an investment, the more likely I am to win, to compound, and to win big. So with that set up, Dan, why don't you lay out the paper, what it's about, and then we'll get into the key findings of and the results of the paper.
Dave, I love what you just said, because this is if investing was a game, we could say it's a game that actually stacked in the player's favor, and that's really what the numbers show. As far as the genesis of this, it was like 30 years ago that a financial planner in the United States, William Bingham, I understand he's updated his work too recently, wrote a paper to help his clients as to, what is the proper asset mix so that you can prepare properly for your retirement. And preparing for your retirement reflected the pretty simple goals. People wanted to live 30 years from the date that they'd retired. They wanted to sustain their prior standard of living throughout retirement, and that was on an after inflation basis. So how much did you need on that retirement date? And given varying levels of asset mix, what was the chance of busting yourself before the 30 years was up? So that was done in a very different climate. Interest rates were far higher. Markets were far less sophisticated. The opportunities to invest in different assets just weren't there. It was a fairly narrow selection set that was available. And about a year ago, we thought we should update that paper. It became foundational to retirement planning. And the foundation was that in general, you should withdraw 4% of your savings every year, index that by 3% every year to account for the expected and normal inflation rates that we experienced since the 1920s. And you could expect that that money would last for about 30 years in most cases. I'm talking most cases being 80 to 90% plus. So essentially, if you put $1 million away and took 4% a year out, indexed it at 3% a year, you'd get $40,000 a year and you'd live for 30 years with that. So it sounds like a lot of money, but with compound interest, hopefully we'll all make it there. So we said, did that actually work? Let's go back and check if math worked and if it still works given today's numbers. And actually was quite surprising despite how simple that is. In a business that's so sophisticated and complex, it really did work. And he used a 50-50 portfolio. 50% of the savings was invested in UST bonds. 50% of it was invested in the S&P 500. So imagine you have so many other choices now. You also have choices to vary the asset mix. So the findings we're very excited about. And we were actually surprised by some of the things we did find.
Yeah, I was in I was doing a presentation for investors in Victoria last night, and as you'd expect, if for the listeners, not all the listeners are from Canada, and not all the listeners have been to Victoria, and so you get a certain demographic when you're in Victoria and you're doing an investment presentation. So a lot of retirees, people, just about to head into retirement or retired. And when I put up some of the charts from the paper and started to explain, just as you have, the basis of what you were trying to accomplish, and then some of the base results, which are, you likely need more growth or stocks in your portfolio than you think. And it's not just when you're 18. It's not just when you're 58 like I am. It's even when you're in your 60s and 70s and in retirement, because that growth is so important, because people overrate the risk of the ups and downs in market and forget about, and they should remember now, maybe more than they have in 40 years, what inflation can do to your purchasing power and your lifestyle when it's just sitting there in the background. And again, it might tick along for 2 or 3% for a while, but then you do have these spikes from time to time, and the impact. Even with, I think of myself, you London too. You're working and you're earning a good living, and you go to the grocery store, or you go to buy clothes, you go to have dinner somewhere. The prices have just, you've jumped 25% through this period of high inflation of prices. And so again, if you haven't increased your income by 25% at the same time, you've lost purchasing power, and you feel that squeeze, which so many people are feeling.
Right.
And of course, in retirement, now we're not making more. We're not earning a salary. We're living off our investments. So, anyways, what's the as you look at it, what do you think are some of the key findings? And for you, what's kind of the headline out of what you found from the paper?
I think there's two key findings. The first one goes back to a paper that Gary Brinson wrote 40 years ago, maybe 45 years ago. And in the paper, he confused us all as analysts. He said the most important decision that one will make in their financial life will be their asset mix. Of course, all of us that deal with stocks, bonds, gold, whatever, all day long, thought that meant about what day do you buy them, what day do you sell them. It meant nothing about that. It meant, do you own equities anyway?
Yeah.
Because if you decide to not own risk assets, or decide to own just the least risky assets in your investment plan, you've determined your outcome right there. All the rest of what we do in finance is just working around the edges, adding a little bit here, protecting a bit of downside here. The question is, how much risk will you take right from the start? And of course, you want to make that start as early as you can. You don't wait until you're late in life to start worrying about this stuff, because it's the miracle of compound interest. Second thing that was so surprising goes back to another great author, is Daniel Kahneman, famous diversity and prospect theory. So, the prospect theory really dominates so much of what we do in markets and behavioral aspects of finance. But prospect theory basically says that there is there's asymmetric and almost irrational treatment of the fear of loss versus the opportunity of gain. And when you approach your retirement savings with, I just need to have some money to retire, as opposed to, how much could I have when I retire if I did this smart? You get a very different answer. We built a whole bunch of portfolios ranging from all cash, so I can sleep every night. There's 0% chance of not having that cash when I retire. But how long will it last? All the way through 100% equity portfolio, which of course was very volatile. And sometimes as we've seen in the last 25 years, sometimes pretty tough corrections, one being 44% and one not being too far off that. But you take a difference of the most risky portfolio was the 0% cash portfolio. Is it the 0% stock portfolio?
Yeah.
If you sit with 100% cash, you can sleep at night. But there's an 81% chance that after 30 years, you've run out of money. So, and in the worst case, you go back to 1928, and if you create one of these portfolios every year since 1928, one that's 0% stock and one's the 100% stock and all the gradients between that. In one case, the 100% cash portfolio ran out of cash within 17 years. So you retire at 65, by 82 or 83, you could sleep well, but I don't know what you do after that point. So what we're learning from this, kind of intuitive, is that if you don't take some degree of risk, there is no actual wealth creation. There's certainly no offset for the inflation that you just talked about. You're always dooming yourself to a bad outcome. Now, where you sit on that risk spectrum now becomes behavioral. The math says, you should push it maybe as far as 75% equities until well into your retirement. But for some people, that's not necessary. They'll trade off the opportunity of actually creating wealth during their retirement, index that a bit, pull in their stocks, maybe as far as 60, 55, 50%. But you do need a healthy amount of stocks in those portfolios in order to survive that 30 years. So that's where I think the two biggest learnings. Fear of loss is extreme. You need to shake that to some extent. And that it's not, when we talk about asset mix, it's not buying stocks before they go up and selling them before they go down. That would be terrific. We do a lot of that, and hopefully we do it well more than we do it poorly. Yeah. The most important thing is having exposure to risk assets, not only leading into during your savings year, but in your retirement years as well.
Yeah, I think what's really when I was a practicing financial planner, when I had my clients, and I'd sit and we talk about that first conversation about what you say is so important, that asset mix decision, right? And how much risk am I going to take and set up in my portfolio? And again, thinking long term, because it's a financial planning is a long-term process. And the biggest fear that everyone would have would be, okay, so we're sitting here today, we make the decision, we go into a 60-40 portfolio, 60% stock, 40% bonds, and the market crashes tomorrow. I just happen to set up make my decision around my financial plan at the worst possible time. So I would always run numbers with them too. And these would be people in their 30s and 40s and maybe early 50s. And we'd run through that scenario, and people would be surprised. And again, markets drop, but you're continuing to add because you're working, and then markets recover and you end up quite fine. Well, again, now we get to the retirees. So someone who's now in retirement, drawing on their assets. And again, we sit down to make a plan for them, and it's the same thing. Well, what if the day that I decide to retire, boom, it's 1929 again. We have the stock market crash. We go into the Great Depression, World War II. We go through that period. Wow, that I would absolutely ruin my retirement. But again, what this research goes through, if you look at retiring in 1929, you look at retiring in 1937, in where else would we go? 72, 73, 2000, 2008. All these right before we don't get the right before COVID, but I'm sure we already know the how that result's going to play out. But I picked the worst times historically to retire, and still, I need to have growth in my portfolio. I get a better outcome if I have some equity in my portfolio.
I mean, you used 1929, which is the one we all think of,
Yeah.
and even then, this was the right thing to do, was to include a high amount of equities in portfolios. Which one of the numbers that really interested us, though, because we played with a whole bunch of different ways of coming at it and understanding and explaining it, was I think you should really now take the pre-war years out of the data. We didn't in our analysis, but I think it makes our analysis super conservative as a result, as was Bain's analysis. The reason is that in 1929, we didn't have the institutions in place that we do now. The Reserve, the market regulation, all these kinds of things. The understanding of monetary policy was know what happened in 35 to 37 when they created the secondary low in the Depression. They did everything wrong. They're actually withdrawing. They're actually reducing the money supply as the economy was recovering because they feared an inflation. So we know not to do that. We know quantitative, all of these things that happened. We learned more in 2008. We learned more in COVID. So I have to think that the institutional responses to really big threats to growth and the economy, limit the risk of the catastrophe of the Great Depression. One can believe that or not. If you believe that, I do, that the world is actually a little bit safer than it is now. That doesn't make it safe, because we did see the 44% correction in 1999 to 2002. We saw a huge one in 2008. But nevertheless, if you take the pre-war data out of it and you consider how long does it take if I was so unfortunate that I loaded up my portfolio at the day before a big bear market started or an average bear market started, how long would it take me on average before I finally got back to those prices? Well, the answer is 3 years. So you're offside for 3 years, but your retirement period is 30. So it's 10% of the period that you'd be actually retired for. So if you can sleep through those average of 3 years, and sometimes a little shorter, and sometimes they're a little longer, but they're not a lot shorter, not a lot longer, you're better off to do it, even if it was the worst day. And if you're like most of us and you're saving fairly constantly on some kind of a program over time, you're going to get some good buy days and you're going to get some bad buy days. And on average, you're going to get an average bill, and that's all you need.
That's all you need. And I think back to, so from the global financial crisis, which is an experience that most investors who'd be listening to this podcast would have experienced or have read about and studied if they're an advisor. I think of a conservative portfolio. I just know the conservative portfolios that you and your team run. I believe even after the massive correction in 0809, a conservative portfolio recovered, I believe it was 21 or 22 months. A balanced portfolio, a 60-40 portfolio, took about 42 months. And again, just such a surprisingly quick bounce back. And again, I love your thought around the, eliminating some of this old time stuff. You want to put it in because it's important. And again, like you said, the first thing people think of 1929. That's what we all grew up learning about and studying. So you got to include that. But again, we've made so much progress, and you see that in the experience of 0809. And then the other one, and what leads to my next question, is the experience from 2000 to 2002, and it's a little bit farther back in the memory banks for some people, but that was what we would call the tech bubble burst, right? And so we had I was saying to a group last night as we were having a conversation afterwards, that the similarities in some ways between the market today and the market then. Back then I would take my company, Dave Company, and I would rename it Dave.com. And my stock would go through the roof. People would pay $200 for every dollar of revenue that I'm generating. And then they figured out I was never going to generate any revenue, and my stock collapses. Today, I would rename my company Dave.ai, and I'd see the same things happening. But what happened through that market, what was interesting, is that my technology stocks collapsed in that space, but my broader portfolio actually did fairly well if I was invested in quality. So what you're talking about here, do you think about ways of that you might manage your equity? So say I'm going to go with a 60% equity portfolio, but is there ways that I would position that portfolio in retirement relative to through my accumulation years to even protect myself? So to kind of almost get the best of both worlds, I get the growth of equities, but I'm playing a little bit of defense as well, so I can sleep at night.
Yeah, I think you just answered the question. And it's one of the things we did put in the paper. When Bain wrote the paper, he used just stocks and bonds, US stocks, US bonds, and that was it. But they were fairly narrow, unsophisticated markets at the time. Canadian market at the time was tiny. There was no investment grade market in Canada. There were a couple of bank bonds in there, and there's certainly no high yield market. You wanted high yield bonds, you had to go to the United States, buy some of those, hedge them back to CAD, and that was it. So you didn't have a lot of choices. You have tons of choices now. You should take them. The best thing you can do is not guess and or ride with the single group that's driving things. For example, the Mag 7 or AI right now. You should carry diversified portfolios. You don't have to make all those choices all the time perfectly right if you have a diversified portfolio. You should have in equities exposure across geographies. You can have overweighted or underweighted relative to broadly diversified or recognized indices, whatever. But you scatter that across a bunch of different geographies. You're blending together a bunch of business cycles and politics, outcomes, etc. You go across different asset classes. And in the bond market, you just don't buy sovereign bonds. You also blend it in credit. In our case, we have much more credit than we do sovereign bonds. And you don't just have investor grade. You have tiering down exposures towards things like some high yield bonds, some CLOs, some emerging. There's so many choices. And so that you have some things going up and some things going down, but the broader trend you're getting a full piece of without having to make extreme choices like today it's AI and then I think AI is expensive and I'm out. Those will be blended in appropriate amounts within a diversified portfolio. So I think that's a critical aspect of these savings plans that wasn't picked up 30 years ago. Maybe it didn't need to be contemplated 30 years ago, but absolutely, why wouldn't someone take up the opportunity to have all of these different exposures?
Yeah, which takes us back to the start of the conversation that you're in London. And 30 years ago, if you were the head of an investment management firm in Canada, you wouldn't be based in London because I was sitting out again as a planner at that point in time. And I had a Canadian equity fund, I had a US equity fund, I think we had a Japanese equity fund, and a bond fund, which invested primarily in government bonds in Canada and the US. That was about it. So now, if I'm a Canadian investor, I can walk into a bank branch somewhere, I can get online, and I can access virtually anything I can imagine from an investment perspective to build a portfolio. So it's something that, and this is why we do the podcast, because we want people to understand that there's so much choice out there. There's so much ability to get your portfolio positioned uniquely for yourself. And the more you learn, the more you work with a good advisor, get the right advice, the better you'll be positioned to grow your money while you're saving and to have it live through your retirement and have the retirement lifestyle that you want.
Yeah, absolutely. That period, 1999 to 2002, still fascinates me. I lived through that as a macro strategist. Not the easiest job to have when, this is never happened. And there's so many learnings we walked away. What's fascinating to me is between 1996 and 1999, that market progressively narrowed. So it started with all stocks going up and then less stocks were going up. And then finally, we were down to about 10 or 12 massive global technology stocks where all that was going up and driving the index. So everybody had a sense that everybody's making money but me, because of course, most portfolios were not actually tilted in that narrowing group of stocks. And then you had this devastating bear market from 1999 to 2002. I guess that's the one that's down actually 54%, not 2000. Nevertheless, down almost 50% or a little more. Interestingly, do you know during that period, more stocks went up than down?
Yeah.
So the breadth of the market, participation in the market actually didn't do what the market appeared to be doing. Another reason why one wants to diversify. The reason one wants to diversify is the indices don't always tell us what's happening within that market.
Yeah, and when it's hardest to diversify, is likely the most important time for you to be looking at diversifying. So as you say, when that market was concentrating, right? And if I'm not in that, I'm losing out. And maybe you are in the short term, but then the market has a funny way of getting back to normal. And that's the learning from, as you say, from that period for investors today, and kind of what we're looking at in markets right now with that smaller group of stocks that's leading the way and is so important.
So if you start to sort of make a hierarchy of what's important here, number one, own stocks, lots of them. Well, number one, start saving early. Number two, own stocks and lots of them and well into your retirement. And number three, diversify those positions broadly. You don't have to rifle shoot this.
Yeah. I it's especially when I run into young people. I was sitting at a cafe in Munich, and the young woman from the UK sits beside me, and she sees me looking at reading an economic report. I might have been reading your paper at the time, and she's, what do I do to what's the one thing you'd advise me as a young person to invest? And it said simply, buy stocks. Buy stocks. And I put, as you just did, the filter with diversify, and added a few things. But if there's just one thing you do, buy quality stocks, and time will take care of the rest for you. Little different in retirement, but still that growth is important, and that's why this paper is so fantastic.
Another number that really sprung out, fascinated us, was, again, going back to prospect theory. Retirement planning is all about not running out of money. But if we could relax that a bit and say, well, if I took the tiniest chance of running out of money, because you can correct course during it, and in these studies, of course, you can't correct course. You set yourself on a course at age 60 or 65 and you can't change. Well, of course you can change. But at the 60-40 portfolio, which in my mind is actually not the optimal portfolio, but 60-40, optimal would be somewhere above that. In the 60-40 portfolio, if you took out 4% a year, index that by 3% a year for inflation, in half of cases, you had the same amount of money when you died, or 30 years later, than when you retired, because you're only taking out 4 and you're earning 6 or 8. So you're actually, you're spending, you're looking after your retirement and actually getting wealthier during the period. And then as you index those equities up, of course, there are certain scenarios where you can end up 30 years with multiples of what you retired with. It depends, of course, on the investing experience during your retirement period. But the chance of crashing out, of running out of money, was never all that high once you got into these balanced type portfolio's.
Yeah, I showed the kids that part of the review. They were quite excited about that, with the prospects of the wonderful estate we might be leaving behind. But that's another issue that we have to deal with as parents. So, Dan, before we go, so the paper is great. You can get the paper if you go to rbcglobalassetmanagement.com, and the paper is there in Insights. If not, you can talk to any RBC advisor, and they can help you find it. And I'd really encourage you. It's not a long read. It's very straightforward. There's lots of nice graphs in it and charts that you can play with. So you can go as deep as you want, as always, or you can just gloss over and get the basic gist of the paper. But before I let you go, just what are your thoughts about where we are in the global economy right now? I know a lot of when I'm out with investors, they're nervous about things that are going on. They certainly look south of the border, and they're concerned about some of the things that are happening there, and just the tone and manner of leadership there. And as Canadians, of course, we felt a little bit of that directly since Inauguration Day. What are your thoughts about where we are in the global economy, and where we might be in the next 12, 24 months and beyond that?
I would say that those fears that you just talked about, you eliminate it. Maybe disappointment, I would share all that as Canadian, and also as an investor. But we just came from a series of meetings where we're looking at our tactical asset mix, and 6 months ago, and I think Dave Mackay captured this well, talking about moving to a principles-based system towards more power politics. But that's not good. That's where, and the world is changing. And as part of that, there was massive, the pathways towards bad outcomes had really opened up all the way from, tariffs, longstanding trade relationships, stranded assets, where there had been major capital investments made that suddenly they were made in the wrong place because of the stroke of a pen of one person, all this, the concentration of power, all these types of things, and say, well, the world is, as an investor, there's just a lot more chance of bad things happening now than there has been in the past. I had to take risk off the table. And of course, we did have that serious correction during the spring. Interestingly, at the end of that correction, we got very strong technical signals that the worst is behind. And we fortunately responded well to that. And we're well positioned for that because remarkably, what the stock market has gone through an historic recovery since the spring. And what the stock market is saying, and one isn't sure what's going to happen tomorrow, the next day, or the next month, but what the stock market is saying is that we're going to make it through. There's going to be corporate profits there. Inflation isn't the problem, that at least at the level that one had expected. We always have to remember that the market knows more than all of us. And the market's message is actually quite benign right now. Now, valuations are a different concern. Because early in my career, little pea trees don't grow to heaven. But the song said there will be checkbacks based on this has just gone too far. You're paying too much for a dollar of earnings. But we think that those checkbacks will be more in the sense of correction rather than end of bull market. So our outlook is still constructive. Recognizing higher valuations means higher proof points or hurdles that have to be cleared in order to keep stocks going. The pace of appreciation of stocks, one can't expect this to continue, but that seems to be a lesser chance of recession. While growth should slow over the next year as we absorb some of these big changes. I don't think as Canadians we're going to enjoy reading all the news, but the Canadian stock market has actually been one of the world leaders since that last correction ended.
Yeah.
So it's not a benign view, that's for sure. It's on balance, modestly constructive. We need to watch valuations very carefully, especially in the United States. But then when we look outside of the United States, in countries including Canada, they haven't led for many, many years, and they seem to be getting their chance. The window's opening for them.
Yeah, which is fantastic as a Canadian investor. My favorite story around the market, seeing things that we don't, is in the midst of COVID, which again is in recent memories. And of course, in late February, as we're just starting to understand in some form what COVID is going to represent as a part of our life, how it's maybe the most significant event in most of our lives up to this point, and the market starts to drop from an all-time high. It drops 35% in a month, and on March 23rd, 2020 is the bottom of that drop. And again, if you go back and you think of where we were with respect to COVID on March 23rd, 2020, we had just shut down the global economy 10 days before, right? So it's not like we had any epiphany that we were ultimately going to get a vaccine, or that we were ultimately going to get to a point of where immunity or the virus would weaken to the point where we could live and survive with it. But the market shot up at that exact point. And again, think back to where you were on March 23rd, 2020, and where we were in our understanding. We were still wiping boxes down that were being delivered to the house, all right, at groceries, and double washing the vegetables, right? And yet the market saw through that and started this massive appreciation, because it said, just as you said around the situation we're in right now, the markets went, you know what? We're going to be all right. We're going to get through this. Maybe we're not exactly sure how, right? And we don't know what the bumps along the way are going to be. And there were some bumps along the way, but we're going to get through this. Everything's going to be fine. And so that's the way I think I think you're exactly right. We got to think about this situation as well, the same way, because over time, as just a human race, we figure things out pretty well.
Yep. I know you want to close this off, Dave, but there's one, I think, important point that relates to this is, as a result of all the volatility, the fears, an absolute mountain of cash is set. And it's $7 trillion in the United States. If there's fuel to keep this bull market alive, one doesn't have to wonder, Usually half of that will come into renewable markets. You get $3.5 trillion sitting on the sidelines, another $500 billion sitting in Canada, 250 billion that should be in all these numbers. They're extraordinary. The problem for investors is, sure, that could be fuel for future stock price appreciation down the road. That's also money that didn't earn anything during this long period. We looked at this risk aversion that is so common to investors, and I guess to some extent it's a critical part of investing, is that if you had looked at when short rates went above bond yields, it was two and a half years ago, and at that point said, I'm just going to own bills, I'm not even being paid to own bonds, and certainly stocks are a bad thing to own until the end of 2024. So for that roughly 2-year period, you would have clipped something between, 3 and 5% because bills peaked at 5%, rates peaked around 5%. Not a bad return, certainly on cash relative to what we've earned in the last 20 years. Just stock surgery in that period, it compounded at 12.8% a year. So you're down 780 basis points a year, at least.
At least.
I think that when we think of this paper, we try to push ourselves out of the short term and into the long term. One's not saying you take the $7 trillion, throw it at the market today, but you got to come up with a plan that you can comfortably leg yourself into a more reasonable cash position. Because what you're protecting yourself against, whether it's March the 20th with COVID, whether it's the spring of 1973 with the Nifty 50, what you're protecting yourself in will pass, but you will for sure miss out on the long-term returns of the equity market.
Well, can't think of a better way to finish things off. I never. By the way, Dan, I never want to cut you short because you always have something. And the cash thing was another thing I was talking about with investors last night because and it is so important. You still, despite the incredible run that we've seen in stocks, there's still so much money that's sitting on the sidelines. And what frustrates me, and again, why we do this, Dan, why I do what I do. You're actually managing the money. I go and talk about it to try and inform investors to say, you don't want to miss this. You've got to be involved in this. And again, this paper helps so much for people to see and understand what you're giving up and the risk you're taking that you don't think you're taking. And that's why I wanted to get you on today. And Dan, I know how busy you are, but thank you so much for your time today. You always, I have the privilege, as I always say, whenever I say, what's it like to work with Dan? I go, what I love working with Dan over the years, I get to spend time with him, and I just listen, and just like the listeners are getting today, I just learn. And I just get and it just helps you pull everything together. You have such an amazing way of pulling everything together with all your experience and success. So we all benefited from that today because you gave us our time. So Dan, thanks. Give my best to Brenda, and safe travels.
Thank you, everybody. Enjoy your holidays. Thanks for your time. See you.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.